Recently in the news, and particularly on social media, the headline has been government shutdown, recession is looming, and the market has to crash. None of which is supported by reality, but that's irrelevant. It sells online and it generates click through to somebody's website, and then you get a promotion for subscribe to us and pay just so much for the first 30 days, and then we'll tell you what the real secret is if you re-up for a lot more money. It's a marketing tool trying to substantiate why there would be a recession with the market continuing to rise the way it is a really hard argument to support. My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So one of the questions is, why is the market going up? I mean, the government's shut down. Well, let's think about that. How many of you want more government involvement in your life?
Right. Maybe you should stop right there. The government shut down. Okay, now we know why the market's going up. Yeah, most of the troublemakers are off the board right now. It's a beautiful thing.
Well, yeah, and there's some precedent for this in the past of what they're going to do. The politics set aside, when we look at the market, it's continuing to rise because corporations are profitable.
Correct.
Now, if we get an extended government shutdown and we have hundreds of thousands of government employees with no paychecks, spending is going to contract, and then we'll start seeing an impact on earnings. But a short shutdown is kind of a blip in the radar that quickly disappears, goes away, and we're back to life as normal. We have the risk of prices are so high, profits don't justify those prices.
Right.
But that's a hindsight evaluation. We're looking at where profits have been, where prices are today, when Mr. Market, so to speak, is looking at where he expects profits to be 3, 4, 5 years out from now, and say, this is going to be a winner, and I'm willing to pay more. That guy wants to sell it. I'm willing to pay that right now because I think it won't be $30 in 5 years. I think it'll be $150 or $300 in 5 years. That's the difference in the evaluation. It's forward-looking forecasts versus PE valuation based on recent history.
And correct. Yeah, market prices are almost always, if you're looking at the market prices, market levels, those are almost always forward-looking. Investors are always trying to figure out, where is this thing going and what's going to drive it? And it was a financial writer wrote before, the thing that affects the stock market the most is everything. Everything affects the stock market. And so if you want to look at the big picture, it doesn't matter if it's headlines or government or investor sentiment, interest rates, it's all in there. Everything affects the stock market. But boy, oh boy, if you want to look at what really drives it, it's earnings, it's liquidity. Do we have a dynamic market? Are things moving around? Those are the things that can really put the growth in, and you can track those numbers. You can track whether the cash is flowing in or not. And those are the things that can lead to higher highs. And even right now, when we have a group of higher highs, scares off some investors, and you should really be looking at those and saying that means, by definition, things are going pretty well. And this is probably something I should be participating in.
One of the ways you look at that is through sector analysis. And while there are 11 major sectors represented in the S&P 500, there are 3 super sectors, one of which are defensives. Well, those are things that people are expected to buy even when the economy slows down. Just think of butter and toilet paper and toothpaste, toothbrushes, hairspray. Those are all essentials. Right now, virtually nobody's buying those. And in fact, it turns out that even during recessions, that's not a good place to be invested. Now, Wall Street says it is. If we're in a recession, staples are essential and people keep buying them. The problem is that the lowest income brackets are out of money and they get by with as little toothpaste as they can. And
Right.
instead of buying butter, they buy margarine or they go without. It's not a healthy sector. What is healthy right now is technology.
Yes.
That's what's driving the earnings advancement. That is where prices are being driven up. That's also where the fear is being driven up because it looks like it's overpriced.
Sure.
But we can go back and do the same thing back in 1996 when Alan Greenspan said the market was exhibiting irrational exuberance.
Oh yeah.
Well, it was another 4 years before the market actually came to realize we got ahead of ourselves. There are a lot of companies here that own an internet URL and a fancy web page and no product.
We have or no business. Yeah, there's nothing here. There was no cash flowing. That's one of the big differences today with the tech boom that we're having right now, and the with AI driving it, is that there's a lot of money being made right now. There's a lot of cash flowing in. There's a lot of productivity being added. These are huge, huge changes in the way companies work with each other, the way they work with research, and they are significantly more productive, and they're getting more productive more quickly than ever before. So the changes are changing faster, and those are the kinds of things you can hook onto and go with them as long as they will. That's going to change too. Nothing lasts forever, especially in investing, and you always need to watch out for that. But right now we're at the beginning of a huge productivity increase due to AI. There's going to be hiccups along the way. Some of the things that we look at and we say, that's an absolute can't miss winner. And they're going to just vaporize. They're going to get leapfrogged by something else. The market's going to go in a different direction. The economy is going to go in a different direction, different than anyone ever expected. You need to be ready to adapt to that. You need to be watching for those kinds of changes and ready to change what you're doing. Don't get stuck with a narrative. Don't start believing your own headlines and saying, I've got this figured out for the long run. We don't ever have to change this. You always have to be ready to change in investing.
That's right. You should never be anchored into a single position and say this is it forever. One of the things that's changing with a great deal of competition is probably the general population is more aware of, and that is the advent of full self-driving vehicles, which have
Sure.
been largely promoted by Tesla, who is probably the leader. But in China, BYD has actually hopscotched over them and are selling more cars in China than Tesla is. The competition for full self-driving is showing up in robo-taxis. What happens with robo-taxi development is it's testing these new systems. They have each of these companies has a different way to approach the concept of full self-driving vehicles. But
Sure.
we turn around and take a look at what Ford has done. It's basically abandoned electric vehicle production. It's been cutting its production sites and employees. You have Europe with a couple of different models and companies. Actually, I think it was Volkswagen made a commitment to no longer do gasoline powered vehicles, and they
Right.
found out that was a mistake.
Oops.
People prefer them. So, Volkswagen's big enough; they're not going out of business, but they wasted a whole bunch of money on a concept that the public wasn't ready for. And we're going to
And the
find
world, quite frankly, the world wasn't ready for it. There was no way to deliver enough electricity. There was no way to deliver enough electricity in enough different places to make it viable yet. Is it going to be someday? Probably so. And battery technology is going to change. All those things are going to change. So it's not like write off EVs for the rest of your life, but for the immediate future, not quite ready for prime time yet, as ready as everyone thought, because it was a great story. The story was marvelous. Governments across the world, global economy was all behind it. And then realization hit in, well, in reality, we're not quite ready for this. We can't deliver this yet. And as much as we want to, and as much as we told a tale about how great it was going to be, as much as there was huge corporate commitment across the world, that doesn't mean it's doable yet. And that's what you have to look for, the facts underlying of those stories. And that's where you find great earning stocks. It's like this is a real company making real money here, and if they're making a lot of it, great. That's what we're looking for. Don't be afraid of that. Just make sure it looks like it's sustainable, in that their business model is not short-sighted that, well, this is going to be great for about 8 months and then it's going to run into big trouble. It's not the kind of thing you want to be a part of.
Well, and then we have the issue of prioritization. What we've had along the development of electric vehicles and full self-driving concept and application is that all of a sudden AI needs a bunch of power in data center, building out data centers creating a massive demand for plumbers and electricians to keep put them together, and two, to keep the maintenance up, to keep them running. And that has required a massive amount of power coming from utilities, which could have handled some household demand for electric vehicle chargers. But now we shift to this employment application of AI data centers. And which one do you want to do? You want to build out some power for some homeowners to power their EVs, or do you want to build out industry? Well, the industry has more economic impact across the board, so government has to change its priorities. And with that, your portfolio should probably reflect some changing going on also, or you end up with a bunch of dead weight in your asset allocation mix.
You bet. And we covered in a previous podcast that this year is going to be the crossover where companies are going to spend more money on data center and data center expansion than office space. That's more important to the future of industry than building more buildings to house more people. It's like, no. We need more compute power. We need more room for AI to run. We need more room for data storage. And that's where industry is going to expand. Those are the kind of fundamental changes that you need to keep track of, because that's going to really drive going forward where the investment's going to be in business. And that can give you a really good indication of winners and losers, or at least the probability of where best to deploy your capital.
Well, and even if you don't have losers, you may end up with portfolio positions that are not helping you at all, because you own them for a long time and you think, well, I can't get rid of this because I got taxes to pay, or you inherited them and so the tax issue is not a big deal. But my daddy bought this back in the 50s, or my granddaddy bought it back in the 50s. And, it's just part of the family. I just can't get rid of it. But it is an outdated industry that is having a hard time adapting to the new business reality. I have a prospect I've been speaking with. He's an AI guy, tech industry, and he inherited his family stock, and he inherited a family farm. And he's paying more attention to the farm than he is the portfolio. He says, I don't really know what's in the portfolio. I inherited a financial advisor, and I haven't talked to him either. I said, well, we've talked about, I used to have a small farm, so I had a tractor. And I said, so let's just talk about how you operate the farm. You have a big project on one end of your acreage, and you're back at home where the barn is, and you've got a tractor, and you're going to go deal with it with your tractor. But all the way across this acreage, you forgot to lift up your backhoe, and you're dragging it across the ground, the entire 25 or 40 acres that you've got. That's not helping you get your job done. You need to realize that conditions have changed. Get the backhoe out of the ground and recognize something in your portfolio that was good in the 50s or 60s is probably a drag on your performance and your ability to achieve your financial goals in this marketplace. It's time to embrace reality. The marketplace is changing, and it will change again before you need to take this money out of the portfolio. Somebody needs to pay attention to what's going on. If it's not you, you can hire us. At least talk to us about it. Talk to somebody else about it. Find out how we approach money. If you don't have a policy and a procedure to check on what you own, whether or not it should still be in the portfolio, and do that on a regular basis, systematically reviewing what is in your portfolio, you're going to find it very difficult to achieve your financial objectives. If you want to talk about it, our phone number's here, our email's here. Give us a call. We'll be glad to have a cost-free chat with you about what's on your What's keeping you awake at night? What's on your concern list? Probably things you hadn't thought about. If you haven't subscribed to our podcast, do that. If you like what you heard today, share it with your family, friends, and coworkers. We appreciate that. Have a great week and stay tuned. We have more coming.